Hello, everyone. This is our next episode on our automated portfolio series. Over the last week, we've seen that there has been a lot of news, and this news have caused a lot of market volatility. So, what happened over this time is that the portfolio had other stocks that dropped by more than 3% from the peak, and because of that, they dropped out of the portfolio. When I saw that this happened, the assets that were available, the money that became available because those assets sold, was repurposed to give it to the assets that have been earning handsomely. So because of that, now you see that there are other assets that have, for example, 142 shares or 300 shares or 200 shares, is because we take the money that is now made available from the sale of those assets. And remember, this happens automatically. And that money is then reused to purchase new assets within the same portfolio. What is interesting now, though, is that if we look at the 3% drop, these assets that drop by more than 3% are continuing their downward spiral. So if we look at PLPC, it's not only down by 3%, it's now down by 7.25%, right? Prim is now down by 9.3%. USD is now down by 10.85%. So this is why we put this automatic safety guards in our portfolio, because we want to make sure that we don't lose the gains that we have made. But if we see here, we also see that these ones are affected over time, where it appears as though it's going up in price. But the reality, if you look at your total gain, is that it's not. Actually, if you were to keep this, you would be losing money at the moment. And to give an example, if you remember, we created a portfolio on February 23rd when we saw that there was a lot of volatility and a lot of stocks drop. And if we compare that, which hasn't been touched, to the automated portfolio, you see that there's a difference from 493,000 to 508,000. So if you don't have the safety guards, you would be losing almost $15,000 on your portfolio right now. So that's why it's very, very, very important for you to have these safeties where assets that are not performing will be sold. Don't hold on to your losers, hold on to your winners, right? This is the methodology. Something else that I did was, because there's been so many news that there's going to be a lot of market turmoil. Last week around the 27th, I bought gold, I bought defense, and I bought energy. And these are all ETFs. So that means exchange traded fund. What this means is that there are companies that go out and they study and bring together assets into a single fund, and then you can buy this fund. What's important about this is that you buy funds that give you good returns, and also that don't spend too much money in administration, because if they spend too much money on administration, that cuts away from the returns that are given to the investors. So we're gonna be following this portfolio. It's pretty small. It's only $50,000. So we are going to be following these assets to see how well they perform. I didn't put a 3% drop on this yet, because given volatility, this may drop by more than 3% in one day before it has a chance to really grow. So I'm not going to put my 3% drop until Thursday or Friday after I see how these assets are performing. Of course, if I see that something's dropping by like 7%, I'm going to sell it, but I don't expect that. So what do we have now? We have the automated portfolio that has been performing quite well since February 13th. And now we also have the gold, oil, and defense portfolio, which we're going to be following over the next months. And these are the portfolios that we are going to be paying attention to. For anyone who wants to get these portfolios, you'll be able to find the links below on the description. And this is it for today. Thank you for watching.